Good morning. This is Larry McMillan with the stock market update on Monday, March 15th, before the market opens. Well, a week ago, the market was selling off pretty hard and had, in a couple of places, reached an oversold condition, but didn't seem like it was that oversold. However, very strong institutional buying in the Dow stocks last week took the Dow to new all-time highs, and then that dragged S&P with it. The Dow was there about 3 days before the S&P. The Russell 2000 is also at new all-time highs, although NASDAQ, especially the high-tech stocks in the NDX 100, still lagging behind all-time highs. So we've always said SPX is the most important indicator, and if it's going to lead the way, then we'd have to be bullish. So there's just one final criterion that needs to be satisfied, and that's a close above 39.50. That was the high in February, and we just wanted to see a closing high above that. The S&P has closed at a new all-time high, but it's not been above 39.50. The equity-only put-call ratios are basically one of our few remaining sell signals. Those are still rising, meaning there's more put buying going on now than call buying, at least on a relative basis compared to 21 days ago. So these are 21-day moving averages, and they're rising quite steadily. Normally, the market would be going down when that's happening. It's quite unusual for it to be going up, but it is what it is. So the put-call ratios are still on sell signals. Breadth, however, turned very positive. It had 4 or 5 really strong days last week, and as a result, the breadth oscillators are on buy signals, and they're in modestly overbought territory, which is fine. If S&P is going to make new highs, then these breadth oscillators should be overbought. Meanwhile, the cumulative breadth indicators have also reached new all-time highs, so they're in line with the market, although that's not a predictive measure. New highs jumped way ahead of new lows again. New lows were back in the single digits on the New York Stock Exchange a couple of times last week, and new highs are running at very high levels, almost the highest we've seen on this entire rally since a year ago. So that indicator remains very positive. And the volatility indicators are positive as well. The VIX spike peak buy signal is still in effect. VIX itself is below its 200-day moving average, and it's also below its 20-day moving average. So those things are all positive. And the term structure of the VIX futures, that's also positive as well. In 2 days, the March VIX futures will expire, and April will become the front month. So the thing we'll watch there is the differential between April and May. But as long as April trades at a lower price than May, that's again in the VIX futures, that's bullish for stocks. So overall, the pictures change quickly, and certainly that's partly due to the high volatility that we're still seeing in this market. The average true range since the middle of February for the S&P has been about 75 points a day, which is well, very high. We don't usually see anything of that magnitude. So that's confused things a little bit perhaps, but the S&P chart is leading the way. All it really needs to do is close above 39.50, and new long positions would be taken at that time. So thanks for watching, and visit our website for information on our newsletters and the new CD instructional set that we're just about to release, I believe, this week.